Introduce WeWork as a symbol of Silicon Valley's entrepreneurial spirit, once a venture capital darling. Its rapid journey from a breathtaking $47 billion valuation to a spectacular collapse stands as one of the most compelling business dramas of our era. This is the story of ambition, excess, and a reality check for the entire startup world, revealing critical insights into modern corporate governance and investor responsibility. At the heart of WeWork's initial allure was its enigmatic co-founder, Adam Neumann. He was a charismatic visionary who genuinely believed he was destined to solve the world's problems, not just rent office space. His magnetic personality and grand pronouncements helped sell investors on a dream far beyond desks and chairs, promising a transformative community and a new way of living and working. At its core, WeWork's business model was deceptively simple: lease large commercial properties, often on long-term agreements, then extensively refurbish them into trendy, flexible office spaces. These spaces were subsequently sublet to individual freelancers and larger corporations alike, albeit on short-term contracts and at significantly marked-up rates. This model was initially hailed as a disruptive innovation, promising flexibility and community. WeWork's ascent was nothing short of meteoric. Fueled by Adam Neumann's infectious optimism and a booming tech market, its valuation soared, peaking at an astounding $47 billion. This made it one of the most valuable startups on the planet, a true unicorn in the venture capital world, drawing in billions of dollars from eager investors who bought into the ambitious narrative of transforming the future of work. The unprecedented influx of capital, described as too much money too fast with no effective oversight on how to spend it, paradoxically became WeWork's Achilles heel. This torrent of funds encouraged an aggressive, unchecked expansion that quickly turned ambition into lavish excess. The fundamental lack of financial discipline and accountability set the stage for its dramatic and inevitable downfall. A critical analysis reveals the fragility of WeWork's valuation. At its height, WeWork was valued an astonishing 13 times higher than its established competitor, IWG plc. This was despite IWG having 5 times more members, 6 times more locations, and operating in 5 times more countries globally. Crucially, WeWork consistently operated at a significant loss, while IWG was a profitable entity. WeWork became notorious for its extravagant expenditures, quite literally burning billions of dollars. By 2018, the company had already accumulated a staggering $2 billion in losses. Yet, remarkably, its valuation continued its seemingly unshakable ascent, creating a widening chasm between market perception and fundamental financial reality. This unsustainable spending was a major red flag for astute observers, yet often ignored. A pivotal factor in WeWork's downfall was the severe lack of effective governance combined with extreme founder control by Adam Neumann. Insiders paint a picture of a cult leader atmosphere where crucial financial and operational bad news was actively suppressed. This environment stifled dissent, prevented objective scrutiny, and enabled a series of highly questionable and ultimately damaging business decisions. The company's ambitious plan to go public in 2019 proved to be the ultimate turning point, a true catastrophe. WeWork's initial public offering prospectus, a mandatory filing with the SEC, finally exposed a long list of previously undisclosed issues to investors. This sudden, unwelcome transparency shattered the carefully constructed illusion of stability, profitability, and an inevitable path to success. The market's reaction to the shocking revelations in the IPO prospectus was immediate and brutal. WeWork's plan to go public fell apart in a spectacular fashion in 2019, completely derailing its anticipated path to liquidity. This event unequivocally marked the irreversible beginning of its dramatic downfall, as investors rapidly lost all confidence in its unsustainable business model and erratic leadership, leading to a mass exodus. The reversal of fortune was incredibly swift. In less than 1 year from its peak, WeWork's valuation plummeted from a staggering $47 billion. The company, once the darling of the venture capital world, found itself teetering on the brink of collapse, desperately needing an $8 billion infusion to simply avoid running out of cash entirely. This was a breathtaking financial freefall, leaving investors stunned. Adam Neumann, despite his once unassailable position and messiah complex, was ultimately held responsible for much of the company's financial wreckage. The spiraling company faced billions in lawsuits from disgruntled parties, and Neumann eventually stepped down from his leadership role, though not without securing a controversial exit package. His departure signaled the end of an era of unfettered founder control and a shift towards accountability. WeWork's tumultuous journey ultimately culminated in its filing for bankruptcy in 2023. The company that had once symbolized innovation and unchecked growth in Silicon Valley was now valued at less than $50 million, a staggering, almost unfathomable drop from its $47 billion peak. This collapse stands as one of the most spectacular and dramatic in recent corporate history, closing a tumultuous chapter. WeWork's demise serves as a potent cautionary tale about the inherent dangers of charismatic leadership when it lacks strong accountability and strategic grounding. Neumann's grand vision, while undeniably inspiring to many, ultimately proved insufficient without the necessary ethical foundation and clear strategic clarity essential for long-term, sustainable growth. Vision alone cannot sustain a company through turbulent financial waters. The spectacular collapse also casts a harsh light on the crucial role of investor responsibility and the need for robust corporate governance. Venture capitalists, captivated by the promise of another unicorn and rapid, outsized returns, admittedly overlooked glaring financial red flags and failed to implement effective oversight on how billions of dollars were being spent, leading to catastrophic results for all involved. The inherent fragility of WeWork's highly questionable business model was ultimately exposed as a critical flaw. The practice of signing long-term property leases while then subletting those spaces on short-term contracts created an immense and unsustainable financial risk. This fundamental mismatch made the company highly vulnerable to market fluctuations and unpredictable changes in demand, a structural weakness that proved fatal. WeWork's dramatic narrative has cemented its place in business education and popular culture, notably captured by the We Crashed miniseries starring Anne Hathaway and Jared Leto. It serves as a stark, modern cautionary tale of the profound risks involved when unchecked ambition, rampant excess, and grossly inflated valuations collide without the essential guardrails of proper corporate governance and financial prudence, a lesson for future entrepreneurs. While WeWork itself imploded, the underlying concept of flexible, co-working spaces continues to evolve and thrive. Its spectacular collapse has forced the industry to critically re-evaluate and adopt more sustainable business models, implement robust governance structures, and embrace realistic valuations. The market for flexible offices is now characterized by a focus on practicality and profitability, learning from past mistakes and striving for resilience. Beyond the captivating headlines and dizzying valuations, the spectacular fall of WeWork left a significant human cost in its wake. Thousands of dedicated employees faced immense uncertainty, job losses, and shattered professional dreams. Simultaneously, investors, ranging from massive institutional funds to smaller individual stakeholders, saw billions of dollars vanish, a stark reminder of the real-world impact of corporate missteps and unchecked ambition. The intricate and dramatic story of WeWork is far more than just another business failure. It stands as a defining saga of our contemporary economic landscape. It vividly encapsulates the intoxicating promise of technological disruption, the insidious perils of unchecked ambition, and the indispensable importance of sound financial principles, ethical leadership, and robust corporate governance. Its profound lessons resonate far beyond the world of flexible office spaces, serving as a timeless warning.